What if I told you that one of the most powerful investment strategies ever created requires almost no stock picking, almost no market forecasting, and almost no effort? It sounds too simple to be true. Every day, millions of investors spend countless hours trying to find the next Tesla, the next Nvidia, or the next company that will make them rich. They watch financial news, follow market influencers, and constantly buy and sell stocks. But here's the surprising reality. For most people, trying to beat the market is actually the wrong game. The investors who consistently build wealth over decades often do something much simpler. They own the market instead of trying to outsmart it. That is the power of index funds and ETFs. And by the end of this video, you'll understand why diversification has been called the closest thing to a free lunch in investing, why legends like Warren Buffett recommend index funds for most investors, and why this simple strategy has transformed millions of ordinary people into long-term wealth builders. The core idea behind this approach is diversification across many investments rather than concentrating everything in a few bets. It is one of the strongest arguments for index funds and ETFs as a practical long-term investing strategy. Let's begin with one of the most important concepts in investing: diversification. Imagine you have all your money invested in one company. If that company thrives, you do well. But if it struggles, your financial future could be devastated. This is concentration risk. Now imagine instead that your money is spread across hundreds or even thousands of companies. Some will perform brilliantly. Some will disappoint. A few may even fail completely. But the success of the many can outweigh the failures of the few. That's diversification. Think about the insurance business. Insurance companies know that claims will be paid, but they remain profitable because they spread their risk across millions of policyholders in different locations, occupations, and age groups. Investing works the same way. Diversification reduces the damage that any single investment can cause. This idea was mathematically proven in 1952 by economist Harry Markowitz. His research became known as modern portfolio theory. Markowitz showed that a portfolio of many different investments could actually be less risky than owning just a few individual stocks. Why? Because investments do not all move in the same direction at the same time. Technology stocks may fall while healthcare stocks rise. Energy companies may struggle while consumer companies perform well. These differences help smooth the overall performance of a diversified portfolio. Markowitz's insight was revolutionary. He argued that diversification could reduce risk without necessarily reducing expected returns. In other words, investors could improve their risk-adjusted outcomes simply by spreading their investments wisely. Modern portfolio theory showed that combining different investments can reduce overall portfolio risk because assets do not move perfectly together. That insight became a foundation for diversified investing. This brings us to index funds. An index fund is designed to track a market index. Instead of trying to choose winning stocks, it simply owns the companies in that index. For example, an S&P 500 index fund owns the largest 500 publicly traded companies in the United States. When you buy one share of that fund, you instantly own a tiny piece of hundreds of businesses. Technology companies, banks, healthcare firms, consumer brands, industrial manufacturers. You're not betting on one company. You're participating in the growth of an entire economy. If Apple has a bad year, other companies can help offset the impact. If one sector struggles, another may perform well. This is diversification in action. And this simple idea became a global investing revolution. That revolution was led by a man named John Bogle. In 1976, Bogle launched the first retail index fund through Vanguard. The investment industry laughed at him. Critics called it Bogle's folly. They argued that no one would want a fund that merely matched the market instead of trying to beat it. The fund even lost money for its first 17 months. But Bogle understood something that many professionals ignored. Most active fund managers fail to consistently outperform the market after fees and costs. So instead of trying to beat the market, why not own the market at the lowest possible cost? That simple question changed investing forever. Today, Vanguard manages trillions of dollars, and index funds have become one of the most popular investment vehicles in the world. Index funds track broad market benchmarks, giving investors exposure to many companies across sectors through a single fund. John Bogle's low-cost indexing approach eventually grew from a controversial idea into one of the largest investing movements in the world. But diversification is only half the story. The other half is cost. This is where many investors unknowingly lose enormous amounts of money. Imagine two investors who earn the same market return. One pays a fee of 0.1%. The other pays 1.5%. That difference may seem small, but over 30 or 40 years, it can become hundreds of thousands of dollars. Why? Because fees compound. Every dollar paid in fees is a dollar that can no longer earn future returns. Index funds are remarkably inexpensive because they do not employ armies of analysts trying to pick stocks. They simply track an index. They also trade less frequently, which reduces transaction costs and taxes. This means more of the market's return stays in your pocket. Burton Malkiel, the Princeton economist and author of A Random Walk Down Wall Street, put it simply: the lower the costs, the higher the returns are likely to be for the investor. This is one of the few areas of investing where you have complete control. You cannot control market returns. You cannot control economic recessions. You cannot control interest rates. But you can control the fees you pay. And that control can dramatically influence your long-term wealth. Low-cost index funds keep expenses extremely low and avoid much of the trading activity that can reduce investor returns. Lower fees leave more of the market's growth in the investor's account over time. Perhaps the strongest endorsement of index funds comes from Warren Buffett. Buffett has repeatedly stated that most investors should own a low-cost S&P 500 index fund. Think about that for a moment. One of the greatest stock pickers in history recommends that most people avoid trying to pick stocks. Why? Because Buffett understands how difficult active investing really is. Even Benjamin Graham, Buffett's mentor and the father of value investing, emphasized the importance of broad diversification and considered it a companion to margin of safety. He warned that individual investments can fail, but a diversified group of investments has a much higher probability of producing satisfactory long-term results. The message from these investing legends is remarkably consistent. Diversify broadly. Keep costs low. Stay invested for the long term. That may not sound exciting, but investing is not supposed to be exciting. Excitement often leads to speculation, and speculation often leads to losses. Successful investing is usually boring. It is disciplined. It is patient, and it is surprisingly simple. So, what does this mean for you? If you're just starting your investing journey, you don't need to find the next market superstar. You don't need to predict recessions. You don't need to watch stock prices every day. You can begin with a diversified, low-cost index fund. If you're already investing, take a close look at your portfolio. Are you heavily concentrated in a few stocks? Are you paying high management fees? Do you have true diversification across different sectors and asset classes? Small changes made today can have a massive impact over the next 20 or 30 years. Remember, wealth is rarely built through perfect timing. It is built through consistent investing, diversification, low costs, and the power of compound growth. The market will have crashes. There will be recessions. There will be scary headlines. But history shows that disciplined investors who remain diversified have been rewarded over the long run. That is the real lesson of the Vanguard Revolution. It is not about getting rich quickly. It is about giving yourself the highest probability of long-term financial success. If you found this video valuable, make sure to like, subscribe, and turn on notifications because this channel is dedicated to helping you build wealth through smart investing and financial education. And in the comments below, tell me this: do you currently invest in index funds, or are you still picking individual stocks? I'd love to hear your investing strategy. Thanks for watching, and I'll see you in the next video.